Hi guys, so today we're going to talk about getting started with investing in 2024. So if you are just starting out, if you're a beginner or you're thinking about starting out, hopefully this video will help you get started in the big world that is the investing world. Now this video is sponsored by XTB, who have just released a really cool feature called investment plans, but more on that later. So firstly, the question that I get asked a lot by people who aren't already in the investment world is why invest? So let's have a little chat about why investing is just absolutely crucial in my opinion. A lot of people see investing as just making money and something that's like really complicated and something that you have to do day trading or something like that, and it's just completely not it. The way that I see investing is that it's essentially securing your financial future. It allows you to grow your wealth, beat inflation, and achieve your long-term financial goals. So essentially, by investing, you're not just saving money, you're letting your money work for you. You've probably seen that on quotes and things like that if you're following any sort of financial accounts, is letting your money work for you. You're giving it potential to grow over time and beat inflation, which we all know is eating away at the value of our money. And by that, you're essentially ensuring that your purchasing power remains strong. Now, obviously, past performance isn't necessarily an indication of future performance, but it's worth looking at the historical returns of the stock market, and generally over time, investing tends to beat inflation. So you may have years where it doesn't, but this is why I'm a big believer in investing in the long term. So don't invest money that you might need in the short term, because then chances are you might end up having to sell that money when you need it and sell it at a loss. Okay, the next thing is things to watch out for. So as a beginner, you may not know what you need to watch out for. So let's have a chat about the potential pitfalls so you know what to expect. Now, one common mistake that happens very often is not doing enough research before making investment decisions. Jumping into the stock market without understanding the basics can lead to essentially quite costly errors. Another pitfall that for me is like something that I talk about so much on this channel, and it is so important to understand this before you start investing, and it's letting your emotions drive your decisions. Market fluctuations are very normal, and panicking when there's a downturn can essentially lead to you selling at a loss, which is not what we want. I see this so often, essentially panicking as soon as your investments go down and selling. Now, I've had some years where I was up 30%. I had some years where I was down 20%, and I did not sell. It's also likely that when you get started investing, you are more likely to see those red sort of downturns than you are over the long term. When I still had my full portfolio, which I had across multiple portfolios, and if you don't know, I sold a lot of it because of my house build and things like that. But when I had all of it, essentially the portfolio that was still green when we had the downturn last year was the one that I invested in back in 2020. So the longest one. And yes, 2020 was another downturn, but also I was investing throughout that year. So consistency is key, essentially, is what I'm trying to say, and not panicking. I'm in it for the long term, and if you are too, then don't stress when you see red. Of course, this is assuming you're investing safely, because if you are taking huge risks or you're investing in things that are extremely volatile and risky, then downturns are something to look at a little bit differently. But as a beginner, you shouldn't really be taking such high risks. So to avoid some of these pitfalls and to learn more and have that basic knowledge, educate yourself, so we'll talk about that next. Have a clear investment plan and stick to it. Don't let your emotions drive your decisions. Okay, so I mentioned educating yourself, so let's look at sources of education. Knowledge is power when it comes to investing, and whether you are just starting out and you're a complete beginner, or you've been doing it for a while, you should continue to educate yourself. Continuous learning is basically essential, whatever world you're in, whether it's the investing world or the world of work or just life. You should always try to educate yourself more. So from my experience and in terms of what I use, here are some resources to help you enhance your understanding. Firstly, YouTube videos or online courses. Now, I don't mean just pay for any course that any finance YouTuber puts out just to make them rich. I mean find reputable sources, good courses, good YouTube videos, and don't ever just look at like one source of information for that. So for example, don't just follow one YouTuber and think everything they say is true and correct, because everyone has a different world view and everyone interprets things differently. So I would never just sort of listen to one person and one source of information. I would watch multiple ones and then make my own decisions. Secondly, books from well-known and reputable authors. So, for example, two of my favorites are One Up on Wall Street by Peter Lynch and The Intelligent Investor by Benjamin Graham. I know books aren't really glamorous, but some of them are really good reads. The Intelligent Investor is a little bit dry. One Up on Wall Street is much better. I've read others that are really dry, others that are really fun to read, but essentially they are really good sources of information. Next is reputable financial news websites. So I'm talking things like Bloomberg, CNBC, Yahoo, places like that that give you up-to-date financial news. Now, when I talk about news, this is a little bit more down the line in your investment journey. So you're not going to learn the basics from these sources. What I mean is follow these places for sources of information such as what is going on. Should I be thinking about maybe changing my strategy or investing in something else or disinvesting from something? And these aren't decisions that I would make, on a whim, where it's like, okay, this company has had a bad earnings report, so that means I'm just going to stop investing and sell, because I would personally never do that. But once you have that core knowledge and you know what to look out for, okay, you might see they've had not great earnings. Okay, why is that? Do you think that's going to continue happening? And sort of doing a little mini analysis on what is going on in that company. Of course, that's if you want to invest in individual companies, because generally as a beginner, I would personally discourage it. But also as a beginner, I fairly quickly got into investing in individual companies. But to be honest, I think I could have waited a lot longer to get started with that. Now, next is platforms that provide additional analysis. So these are platforms that I've talked about previously, such as Simply Wall Street. So these are platforms where they do a lot of the analysis for you. So you don't have to work out ratios or figure out what they mean. They will give you an overall view of the financial health of a company, and you don't have to worry about working all of that out. And the final thing on the list is actually investment platforms that offer educational resources such as XTB. So this is a great option if you want to have everything in one place, essentially. So remember, the more you understand, the more well equipped you will be to make good financial decisions when it comes to your investments. And I know it seems really, really overwhelming and complicated at first, but believe me, it's not. You just need to take it slow. Okay, so next let's talk about investing strategies for beginners. If you're feeling overwhelmed by the vast amount of investment strategies out there, let's try and simplify it. For beginners, a solid strategy is called dollar cost averaging. This is essentially investing a fixed amount of money at regular intervals over time, regardless of market conditions. So you're not looking at trying to invest when the market is down, trying to time the market. You're just investing, whether it's £100 a month, £500 a month, however much per month. You're just consistently investing in the same things every month. This strategy essentially helps to mitigate the impact of market volatility over time. I saw a case study once, and I always remember this, and it was a case study where they followed 3 investors, all with different strategies, and I can't remember if this was true or not, or whether it was just a calculation someone did based on previous market data. But essentially it was 3 friends, and they all, over the same period of time, adapted different strategies. And the one that ended up with the highest outturn at the end of the period was the one that wasn't trying to time the market. So in the short term, the people who were trying to time the market were winning and sort of laughing at this person because they weren't doing as well. But actually over time, that consistency paid off. Another good approach as a beginner is essentially what I do, and it's just long-term investing. So I don't dollar cost average because I don't have the same amount of money to invest every month, but I do invest for the long term. So when I invest in a company, I'm not doing it with the expectation that I'm going to grow that investment in the short term. I'm investing because I believe over the long term, that company will perform well. So these strategies are essentially designed to be straightforward and effective, which makes them a pretty solid choice for beginners. Personally, I think these strategies are the easiest to follow and are lower risk for beginners. A couple of others to consider. One is value investing, but this requires a little bit more effort and calculation, which you may not feel comfortable doing as a beginner. But essentially, it involves finding stocks that are currently undervalued and investing in those. There is also growth investing. So this is investing in companies that you think will have high growth. So think like tech stocks and things. Dividend investing, which is investing in companies that perhaps won't have high growth, but they pay stable dividends, and a lot more available. We don't have time to go into all of them, but spend some time researching them if you're interested. But like I said, dollar cost averaging and long-term investing are the best ones for me. Okay, so now for the question that I probably get asked most often: how to pick what to invest in. So picking the right investments is crucial, and here's some things that you should consider before you invest. Think about your risk tolerance. You need to understand your comfort level with risk before you get started. So if you're the kind of person that can't sleep at night because of your investments, worrying about what's happening, then it may be too risky for you. But based on your risk tolerance, you can figure out whether you want to aim for lower returns but safer investments, or higher returns but higher risk. Diversification. Don't put all of your eggs in one basket. And I don't just mean don't invest in one company, which please don't ever do that. Don't invest all of your money in one company. But I also mean invest across different asset classes and different sectors. So health, cars, finance, etc. This can help you spread the risk of your investments. So if you think about in 2020, whilst certain sectors crashed massively because of everything shutting down, there were others like healthcare that essentially flourished that year. So if you had a well-balanced portfolio, that would have offset the other companies crashing. Finally, your goals. Align your investments with your financial goals. Are you saving for retirement, for a home, for your children's education? All of this should help you guide your investment choices. So if you don't have a high risk tolerance and want something lower risk and easier to understand as you're just starting out, consider investing in ETFs. Now this is essentially where this video's sponsor comes in, XTB. Now you may or may not have heard of XTB. I knew about them a long time ago because they are one of the biggest investment platforms in the world, and I go to a lot of financial events. In particular, they were always very popular in Poland, so this is where I was aware of them at first. Now, they not only offer investing in stocks, they also have just come out with something called investment plans. With an investment plan, you have the flexibility to put together a personalized portfolio of ETFs, exchange traded funds, that aligns with your risk tolerance, industry preferences, and regional coverage, all for 0% commission and 0 management fees. The plan automatically allocates your invested capital into your ETFs according to your designated percentage allocation. They have over 350 ETFs to choose from, which essentially means you can get exposure to not only different sectors, but countries as well. Another important point to note is that they have a very low entry threshold. So investing big sums of money often puts people off when they are starting out, but with XTB, you can get started with just £15. And finally, as I also mentioned earlier in the video very briefly, they also offer access to comprehensive financial education on their platform, both on the website and app, so it's great if you are just starting out. If you would like to try out XTB, you can find the link down below. Okay, final section, how often and how much to invest. So the practical side of investing. So there's no one-size-fits-all answer here, but there's two things that you should consider before deciding how often and how much to invest. The first thing is consistency. Regular and consistent contributions, even if they are small, can accumulate over time and benefit from compounding. So rather than saving up money and then investing a big sum, you're better off just investing those small amounts of money over time. The second thing is an emergency fund. Before investing a significant amount, ensure you have an emergency fund. This provides a financial buffer in case of an emergency and unexpected circumstance, and essentially will stop you from having to liquidate your assets, liquidate your investments, potentially at a loss because you need the money. Your investment strategy should align with your personal circumstances, your personal goals. But just remember, whether you're putting away £10 a month, £100 a month, or £1,000 per month, you are still putting money away for your financial future. People often forget that things like pensions are also investments in the stock market. So they tend to be scared of losing their money, but actually their pension is in the stock market. So as long as you're smart about it, it's not as scary or as risky as you may think. So just remember, investing is a journey, but with the right knowledge and strategies, you can navigate it successfully. If you found anything in this video helpful, please give it a thumbs up and subscribe for more, and I'll see you in the next video. Bye.